Two people form an LLC on the same Tuesday in November. Same state, same filing fee, same articles of organization downloaded from the same Secretary of State website. One of them is building the first brick of something that will take 20 years to understand, and the other has just created a very official looking liability problem with their name on it. The structure is identical. The outcome will not be. This is not legal advice. It is not tax advice. Nothing in this video is a substitute for a qualified attorney or CPA who knows your specific situation. What this is a map of how the structure actually works at each level, what goes wrong, what goes right, and why the families who end up controlling serious multi-generational wealth made certain decisions early that looked almost administrative at the time. Here is the ladder. You have personal income at the bottom, a job, a freelance client, a product you sell online. That income flows directly to you, taxed as ordinary income, fully exposed to your personal liability picture. Level 1 is the single member LLC. You put a business activity inside an entity. There is now a legal membrane between that activity and your personal assets. That membrane is either strong or it is decorative, depending entirely on what you do next. Level 2 is the multi-entity structure, a holding company above operating companies below. Level 3 is the family governance layer, trusts. Family LLCs, operating agreements that survive the founder. Level 4 is what most people have heard called a dynasty, though that word gets misused so often it has almost lost its shape. The transitions between these levels happen at specific thresholds, not arbitrary ones. The threshold from personal income to LLC is approximately when you have something worth protecting, a recurring client, a brand, inventory, a lease, a reputation that is starting to generate real numbers. The threshold from one LLC to a multi-entity system is approximately when the liability exposure of one business could threaten the assets of another, or when the tax structure of a single entity stops being efficient. You will know when you are at that threshold because an attorney will tell you and the number will feel uncomfortably large until it doesn't. The first LLC done right looks like this. It has a purpose, not a vague purpose, a specific one that lives in an operating agreement. It has its own bank account open the week the entity is formed, not the month after, not when things get more official. That week, every contract the business enters is signed in the name of the entity, not your name with LLC written next to it casually. The entity's name because the contract is the record and the record is what you defend in court. The books are clean, revenue in, expenses out, categorized, dated, reconciled monthly against the bank statement. A shoebox of receipts and a Venmo history is not books. The paper trail you can defend is the one that answers every question a judge or an IRS examiner would ask before they ask it. Here's the uncomfortable part. You can do all of this and still lose personally. If you sign a lease as an individual and not as your LLC, the LLC did not sign it. You did. If you put a business expense on your personal card because you forgot the business card and you do not immediately reimburse the entity with documentation, you have commingled funds. Do that enough times and a plaintiff's attorney will argue the LLC is not a real entity at all. That argument is called piercing the corporate veil. It succeeds more often than people expect. The LLC is a structure. Personal guarantees and commingled funds are holes in that structure. Rich families do not obsess over entity design because they read a book about it. They obsess over it because someone they knew lost something real when the structure failed. The liability picture is not only about lawsuits. It is about partners who later become adversaries. It is about ex-spouses in states with broad marital property interpretations. It is about creditors who will find every asset you personally own if they get a judgment against you. The distinction that matters at the foundation level is this. You want to own entities. You do not want to personally own assets. The entity owns the asset. You own the entity. The liability stops at the entity's membrane before it reaches you, if the membrane is intact. Cash flow routing is the thing that breaks most level 0 and level 1 operators. The LLC earns revenue. The owner takes money out. They call it salary. They call it a draw. They sometimes do not call it anything. They just move it. These are not the same thing legally or from a tax standpoint. Owner compensation runs through payroll if the entity is taxed as an S corporation. Distributions are separate. Retained earnings, money left in the entity after expenses and taxes, are not personal income until distributed. Profits on paper are not always cash. An LLC with $90,000 in receivables and $12,000 in the bank has a cash problem even if the income statement looks fine. The operator who treats the business account as a personal spending account will not know they have this problem until they do. The reserves that serious businesses maintain exist precisely because those operators learned this the hard way or learned from someone who did. The failure modes at this level are not dramatic. Nobody announces them. A freelancer opens an LLC, uses one checking account for everything, pays personal bills from it when income is good, stops categorizing transactions in month 4 because things got busy, misses the quarterly estimated tax payment, and by year 2, the books are a fiction that neither reflects the business accurately nor protects the owner legally. There is no entity. There is a document that says there is. The $0 mistake is not failing to form the LLC. The $0 mistake is forming one and treating it like a label instead of treating it like the first brick of something that needs to hold weight. The trigger is not a number on a calendar. It is a specific moment when the exposure of one activity threatens something that belongs to a different activity. You hire your first contractor. You sign your first commercial lease. A client represents 60% of your revenue and operates in an industry where disputes become litigation. Any one of these moments is the signal. The question is not whether to build the stack. The question is whether you build it before or after something goes wrong. The core logic is simple enough to state in one sentence and complicated enough to take years to execute correctly. The business that can be sued should not own the building, the cash reserve, the intellectual property, or anything else you cannot afford to lose. That is it. Everything else is mechanics. Here's what the mechanics look like at a realistic scale. You have an operating LLC. It earns revenue. It employs people or contracts them. It holds the client relationships, the service agreements, the liability exposure. It is the entity that touches the world and the world touches back. Above it, you form a holding LLC. The holding company does not operate anything. It owns. It owns the membership interest in the operating company. It owns the real property if there is any. It holds the accumulated cash the business has generated beyond what operations require. When a plaintiff sues the operating company, the holding company is not the defendant. That distinction is the entire point. The holding company's ownership interests become the real asset. Not the revenue, not the contracts, the percentage of the entity. This is the architecture that eventually allows a family to transfer wealth without transferring a business, to gift interest at valuations that may be discounted for lack of control and lack of marketability, and to separate the people who run a thing from the people who benefit from it. At this level, you are not doing estate planning. You are laying the foundation that makes estate planning possible later. That is the entire value of doing it before the numbers get large. Intellectual property is where most small operators leave money and protection on the table simultaneously. The trademark lives in the operating company, which is the entity most exposed to liability. The codebase, the content library, the brand, the proprietary process, all of it sitting inside the entity that signs vendor agreements and employment contracts and leases. A separate IP holding entity owns those assets. It licenses them back to the operating company under a written agreement with a defensible royalty rate. That rate is not a number you invent. It is a number that reflects what the market would pay for similar intellectual property. The agreement is real. It is executed. It has terms and renewal provisions, and it is treated exactly like a contract between two unrelated parties. Because the day you need it to hold up, the question will be whether it would have survived arm's length scrutiny. Real estate follows the same logic. If the business occupies a space it owns, the operating company should not own that space. A separate real estate entity holds the property. It leases it to the operating company under a triple net structure scaled to your size. The operating company pays rent. That rent is a deductible business expense for the operating company and ordinary income to the real estate entity, which has its own tax profile and its own liability wall. The rent rate needs to reflect market. If you charge the operating company $800 a month for a space that would lease for $4,200 at arm's length, you have created a documentation problem and a potential IRS problem simultaneously. The number has to be real because eventually someone will check. The administrative weight of this structure is not theoretical. More entities means more filings, more registered agent fees, more annual reports, more bank accounts, more bookkeeping hours, more payroll compliance if the structure involves management fees that flow between entities. A management fee from an operating company to a holding company is taxable income to the holding company. It needs a written management services agreement that describes what services are actually being provided. It needs to be paid consistently, not when cash flow is convenient. The complexity stops paying for itself when the asset base does not justify the legal and accounting overhead, which at most jurisdictions means this structure earns its cost somewhere after $300,000, to $500,000 in annual revenue, or when the first significant asset crosses into the picture. The failure modes at this level are quiet and cumulative. One entity signs everything because it was faster that way. Intercompany transfers happen without documentation because the owner knows where the money went. Loans between entities have no promissory notes, no interest rates, no repayment schedules. A judge reads this as one entity. A creditor's attorney reads this as one entity. The veil that was supposed to separate them never existed in any functional sense because behavior pierces what documents claim to create. The structure is not the filing. It is the operating discipline that fills the filing with something real. Two entities on paper with one behavioral entity underneath them is not a stack. It is an argument waiting to be made by the other side. There is a specific moment when the complexity stops being about liability and starts being about people. You can feel it before you can name it. A second business comes online. The real estate portfolio has 4 properties. A minority stake in a friend's distribution company sits on your cap table because the opportunity was real and the handshake felt sufficient. You have more entities than you have systems to govern them. You have more value than you have language to describe who controls what. The problem is no longer structural. The problem is relational. And relational problems do not get solved by filing another LLC. The threshold is specific. Multiple operating cash flows, a real estate portfolio, and passive stakes in outside deals create a governance surface area that good intentions cannot cover. Somebody has to decide when to reinvest versus distribute. Somebody has to decide what happens when one business needs capital and another one generated it. Somebody has to decide what the family member who came in at year 3 receives when the business that existed at year 1 gets sold. Money alone does not answer these questions. Paperwork answers them. Paperwork that was written before the disagreement, not after. The operating agreement is not a formality at this level. It is the Constitution. And most operators who graduate from the first stack of entities have operating agreements that read like templates because they were templates. The provisions that matter are the ones most templates omit. Voting rights and economic rights do not have to be the same thing. A structure that gives a family member 20% of the economics with 5% of the voting authority is a coherent, defensible design. It is also a design that requires explicit language, deliberate drafting, and a family that understood what they were agreeing to before they signed. Manager-managed structures concentrate operational authority in a named manager while allowing passive members to hold economic interests without the ability to block decisions. That design preserves speed. It also creates resentment if the passive members feel consulted after the fact on decisions that were already made. The governance question is not just what the document permits. It is whether the people in the structure can live inside what the document permits without it becoming a wound. Cash flow rooting at this scale is where families discover that informal understandings are not the same as policy. A reinvestment reserve is not a concept. It is a written rule specifying the percentage of distributable cash that stays inside the entity before any member receives a distribution. A capital call provision defines what happens when the operating company needs additional equity and how that burden is allocated across members who may have different liquidity positions. Without these rules, every quarter becomes a negotiation. The sibling who lives on distributions and the sibling who wants to compound equity will have different opinions about the same cash flow every single time. The policy has to exist before the cash does, because the cash will make the argument personal. Minority stakes and joint ventures carry a specific danger that feels invisible during friendly markets. A preferred return structure in a joint venture defines who gets paid first and at what rate before the residual economics split. Drag-along rights give a majority holder the ability to compel a minority to sell under certain conditions. Tag-along rights give a minority holder the right to participate in a majority sale on equivalent terms. These provisions are not adversarial language. They are the grammar of a transaction that has not happened yet. Friendly deals become hostile without them, not because the people change, but because the incentives diverged and the document had no answer. The handshake that closed the deal is not a document. It is a memory. Memories are not enforceable. Succession inside a family entity is where the slightly uncomfortable part becomes unavoidable. Employment and ownership are not the same relationship, and they cannot be governed by the same logic. A compensation policy defines what family members get paid for working in the business at rates that reflect what the business would pay an unrelated person for equivalent work. That number is often lower than what family members expect and higher than what the controlling generation feels comfortable paying. The gap between those two numbers is where most family business governance fails. An underperforming relative who holds equity and draws compensation has two problems that require two separate conversations and two separate remedies. Conflating them, treating the equity as justification for the compensation, or treating poor performance as grounds to threaten ownership, is how families end up in litigation with people they grew up with. Compliance at this level is not administrative housekeeping. It is the thing a bank looks at when you need a credit facility and the thing an investor examines before writing a check. A clean cap table means every membership interest is documented. Every transfer has a written assignment, and every person who holds a stake received it through a traceable, defensible event. K1 timing matters because phantom income, a member's allocable share of taxable income in excess of cash distributions, creates a tax liability that arrives before the cash does. A member who was allocated $80,000 of partnership income but received $30,000 in distributions owes tax on the full $80,000. If the distribution policy never addressed this, the member is surprised. If the entity never disclosed this in the operating agreement, the relationship is damaged. Banks and investors reviewing governance documents are not reading your pitch deck. They are reading whether the entity can make a binding decision and who has the authority to make it. The failure modes at this level are not quiet. A deadlocked operating agreement with 250% members and no tiebreaker provision has no legal resolution short of dissolution or litigation. Entitlement spending, consistent distributions that function as compensation rather than return on capital, erodes the reinvestment capacity of entities that would otherwise compound. A divorce event involving one family member can transfer economic interest to a non-family party if the operating agreement contains no transfer restriction or right of first refusal. An estate event can fracture a unified ownership structure into fractions held by heirs who never participated in building the underlying business and arrive with different priorities. The structure that survives all of this was designed for conflict before any conflict existed. It assumed that people who love each other in one context will have different economic interests in another. It wrote rules for that moment and then let the people inside it operate freely within those rules. That is not pessimism. That is the only governance design that actually holds. There is a threshold where the goal changes. Growth was the objective for a long time. Growth organized every decision, justified every reinvestment, explained every deferred distribution. At some point, the portfolio of operating companies, the real estate, the passive stakes, and the accumulated cash inside holding structures reaches a size where the question is no longer, how do we grow this? The question becomes, how does this survive us? That shift is not sentimental, it is structural. And the entity system that served you at $5 million in controlled assets is not the system that protects $50 million or governs $500 million. The architecture has to be rebuilt for permanence, not retrofitted for it. The map at Dynasty-scale looks like this. A top-level holding entity, typically a trust or a family limited partnership, or a combination of both, sits above everything and hold the membership interest in everything beneath it. Below that are sub-holding companies organized by vertical. One holds all the operating businesses. One holds all real estate. One holds the IP. One holds minority and passive stakes in outside ventures. Each sub-holdco owns its respective operating subsidiaries and nothing else. The top entity does not touch operations. The operating subsidiaries do not own each other. The boundaries are deliberate. They are maintained with the same discipline you would apply to load-bearing walls. Why the separation matters is not theoretical. An operating company carries operational liability. A slip and fall plaintiff, a vendor dispute, a regulatory action, a wrongful termination claim. Those liabilities are ring-fenced inside the operating sub. They cannot reach the real estate entity. They cannot reach the investment vehicle. They cannot reach the top holding structure where generational wealth actually lives. Cross-collateralization, allowing a lender to secure a loan against assets in multiple entities, collapses this architecture. A single lender covenant that ties the operating company's credit facility to the real estate entity's equity creates a contagion path that the entire structure was designed to prevent. You do not sign cross-collateral agreements at Dynasty-scale unless the deal cannot be done any other way and the economics justify the exposure. Personal guarantees still appear. A bank extending a $12 million construction loan does not release the controlling member from personal liability because the entity structure is clean. The guarantee follows the person. What the structure controls is how far that exposure can travel and what it can reach. Governance at this level is not a conversation. It is a written policy document, reviewed annually and enforced by a board that includes people with no financial relationship to the family. Independent advisors are not a luxury. They are the credibility mechanism that prevents the system from becoming whatever the loudest family member decides it is that quarter. A reporting cadence means the board receives financials on a defined schedule. A distribution policy means cash movement follows a rule, not a mood. The rule specifies a reserve percentage, a priority of payment, a timing window, and a process for exceptions that requires more than one person's approval. The rules exist specifically to protect the system from any one member, including the founder. Especially the founder. Succession is where dynasty systems either hold or fracture. The mechanics are specific. Interest transfer over time through gifting strategies, through installment sales to trusts, through structures that move economic value out of a taxable estate while retaining governance control in the hands of whoever earned the right to exercise it. The next generation of operators earns into authority through documented performance milestones, not through inheritance alone. A child who builds and runs a subsidiary that reaches a defined threshold receives expanded voting rights in that vertical. A child who prefers passive participation receives economic rights, size to their contribution without governance authority over decisions they will not execute. These are not punishments. They are incentive alignment written into the document before anyone had reason to object to it. Non-participating heirs receive their economic interest through a structure that cannot disrupt operations. A right of first refusal means the family entity has the option to purchase that interest before it transfers to a party outside the structure. A distribution-only class of membership means passive heirs receive cash without a vote on how that cash was generated. The goal is not to exclude. The goal is to prevent a grievance from becoming a governance crisis. The compliance cost at this level is not optional and it is not small. Multi-state operations mean multi-state filings, registered agents, and varying tax treatments that require coordination across jurisdictions. Lender covenants require regular certification that the entity structure has not materially changed without notice. Annual audits, not reviews, actual audits, become the standard when outside investors or institutional lenders are in the picture. Legal and accounting at this scale runs into six figures annually. That is not waste. That is the cost of operating a system with enough surface area to create real exposure. Sloppiness at this level is not an administrative inconvenience. An undocumented transfer, a missed filing, a distribution that violated a waterfall provision, a personally guaranteed loan that was supposed to be refinanced 2 years ago but wasn't. These are not paperwork problems. They are the kind of thing that collapses a $40 million real estate entity's lending relationship in a single quarter, or hands a litigant a path through the ring fence you spent a decade building. None of this is legal advice. None of this is tax advice. Every entity decision at this level requires qualified legal and tax counsel with specific knowledge of your jurisdiction, your assets, and your family's actual situation. What this is a map of the system. The logic behind why the layers exist, what each one is designed to protect, where the failure modes live, and what the governance has to say before the money makes the argument personal. Identify which level you are operating at right now. Name the next separation or governance upgrade that your current structure does not yet have. That is the only useful output of this conversation. The next Frankie Finance breakdown goes deeper into building elite wealth infrastructure at every stage of the ladder. The system is the inheritance. Everything else is just a number.